most of the components inside these inflation reading reports we've seen are down. So other than energy, it's down, and down to a number below wages, and wages are keeping up if you have a job.
Hey, it's KP coming to you live from Monarch Beach. We're in Dana Point. Are you tripping out? We're at the Core Connect, Cotality Core Connect. We have quite the crowd here. That's Mike Fratantoni, NBA's chief economist. Jim Carroll, housing policy. Oh, there's Kasha. There's Kasha, our chief marketing officer. Her husband, he ran away. Her husband ran away. There's Andrew Bonsall. You might know him. You might have seen him. All right, we're getting out of here. You're there. Okay. Faster, better, and more people-centric. That was a message I heard today from Cotality. And, man, really, really packed day. Ally, A-L-Y, they have like a cool little robot. I don't know if you can see it, but there was like a little robot walking around. You know what's funny is for years I've been saying that there is going to be robots at open houses, and I was never joking, and they literally rolled one out. So, like as an example, it doesn't mean it's going to replace humans, but it is something that you can't make every open house. Not every open house is always, has a person there that knows all the stuff, or it could go side by side with the real estate agent to answer mortgage questions. So I can tell you that every single open house in America doesn't always have a realtor and a mortgage professional originator in there at the same time. So anyway, I thought it was pretty cool. We talked a lot about AI. They had a keynote speaker who really is a futurist and really got into a lot of what's going on with AI and where we're going. It's obviously, it's all we talk about in this industry, but I like that Cotality at the end said more people-centric, because I think, AI is going to help us do more human stuff and cut out some of the stuff that's maybe more busy work. All right, so it's a very important week. It's Fed week. The Federal Reserve starts their 2-day meeting tomorrow, Tuesday, and then Wednesday, of course, they have the press conference, which now, because Fed Chair Warsh doesn't speak a lot or wants people not to speak as much and confuse the markets, there's been a lot more uncertainty, and we've seen that in the bond market. And so is there going to be a hike? Is there going to be, no hike? What will they say? What will the statement say? So I think we're going to get more certainty and more information at this meeting, which I think ultimately will calm the markets. It's also earnings week. And sorry for my dark video. I don't know. I'm going to give you a better scenery back there. That's where I just was. It's earnings week, and the flow of money really matters. Stocks, bonds. We have 4 of the Mag 7 that are doing earnings reports. I think tomorrow, speaking of Cotality, we get the Cotality Home Price Index, which is pretty cool. And then over the next couple days on Wednesday, we will get Apple, Meta, Microsoft, Amazon. They're all speaking and giving their earnings reports. Visa, Coca-Cola, Boeing. There's a lot of companies that kind of give us a pulse of what's going on in the industry. At the end of the week is energy, Chevron, ExxonMobil. And so we're going to get a lot of insights on how the consumer is doing. So we get more certainty, more data, math, science, and facts to kind of blow up, some of the conjecture and fear-mongering that you see online. And maybe some of the fear-mongering is, warranted, and we're going to find out. I personally think, the U.S. consumer is very resilient until it cannot be. And I also think with the Fed meeting, that certainty is going to, tell us which way we're going to go, higher rates or lower rates. And PCE, the personal consumption expenditure, is out on Thursday, which is the Fed's preferred measure of inflation. There's a little de-escalation going on in the Strait of Hormuz and the war in Iran. And so oil took a break today, got into the low 80s per barrel. The bond market didn't quite follow because I think it doesn't believe it's going to be as permanent because it's not a memorandum of understanding And so I'll wrap it up, here pretty quick. But the labor market is still, kind of chugging along. It's not exactly strong. And inflation, we know we have 1 month's worth of reading that was kind of weak, but this PCE report is probably a little more important. But we also know the way the Fed is going to look at inflation and, going forward is going to change. So maybe we'll get some more updates on this Fed meeting press conference on Wednesday. Like, what have you changed with all your 5 task forces? If you're going to redo data and then move the goalposts and the way we look at everything, we need a little more, meat on the bone to chew on. So anyway, that's it. Big earnings week. We're almost out of July. Can you believe it? And our kids will be going back to school before you know it, for those of us that have it. And we'll just keep pressing on, and I hope everyone's having a great week. I'll get back to you Thursday night for the desk.
Hey, it's KP coming to you live from Corona, California. Well, we made it back to the desk, been away, and a lot going on this week. So MISMO Summit is coming up in just a couple weeks. I believe it's August 24th to 27th in Reston, Virginia. Got a nice email from Brian View, who is our CEO of the board, president and CEO, and I'm on the board. And just want to get the word out. They're going to talk a lot about credit scoring models, how we're transitioning into 10T for FICO, all things around credit scoring, AI governance, not taking the human experience out of using AI, GSC updates, all kinds of stuff. So I just thought it was, responsible AI and capital markets. I thought that was a pretty good one too. GSC uniform mortgage data program updates. So there, I got it in for you, BV. Let's go. I'll see you on the podcast tomorrow morning. Okay, so the Fed spoke yesterday, and we had PCE today, and earnings week is humongous. The flow of capital, the flow of money, how it all impacts us. So I just want to say, let's start with housing before I get into the long-winded version of it. Rates have been higher for longer, and they have been restrictive. And we know that because housing, as a component of inflation, that's been kind of a lid on house price appreciation. Some markets are experiencing depreciation. Most markets are seeing a flattening of the higher growth rates we've seen in years. But it's steady because if you have a job, you are still spending money, as evidenced by all the retail sales. You're investing money if you're in the stock market and doing well. Yesterday was kind of a tough day. I might call that capitulation if you want to go look at that curve. Might have seen that little short-term bottom since everything started going down in June. Not a financial advisor, not responsible for your losses, only your profits. But I will say that the housing component in CPI is pretty heavily weighted. PCE, personal consumption expenditure, which is the preferred measure by the Fed, which Chair Warsh made very clear yesterday, has a higher weighting in CPI for housing, and therefore it was a pretty good read for the June month. Now, Fed Chair Warsh did, he was quick to say hey, that 1 month, does not a trend make. But as we know, with house pricing kind of being held down, the appreciation is not going up at the pace that it was before. If you look at the last 3 months of CPI and you average it out annualized over a year, we're at 2.47%. So PCE came in today. Now, core PCE, personal consumption expenditure, that is the reading the Fed likes to look at. A little less weighting on housing, and they've got some other stuff. But they have a task force for that. They are going to redesign it a little bit and try and improve some of those data points in there. The good folks at MBS Highway, Barry Habib, pointed out today that, investment account fees, they're going to look at that. Should 0.4% of the 3.3 core reading or whatever it was they had, I have to go back and look at the numbers, but should that be from stock advisory fees? So it gets us down to 2.9%. It's a good point. Not a lot of people invest in stocks, and so is inflation as bad as it seems? The headline number with energy coming down in June was negative 0.1 for the PCE read, and the core number was up just 0.1, I believe. So it's at 3.3, came down from 3.4. It's not at 2%. 2% is our target. 2% is the target. We are going to get to 2%. Fed Chair Warsh made it very clear. By the way, that's always been their target. It's been their target for a long time. And I think Bernanke or somebody put that target in many decades ago. You have to ask some historian. And so what I found interesting, and I watched all 20 questions from 11 different reporters asking, and they started to get a little cantankerous. How about that? Cantankerous. We've used kerfuffle on here. We got a lot of vocab we're pulling out of the woodworks. But I felt like they were. It was his second meeting ever, and I felt like it's outright disrespect. Now, of course, if you look at who's asking the questions, you can see which side of the aisle that they're on, and that's fine. I mean, this is there is a political component to this. I thought he handled everything, pretty well. If anyone has seen Key and Peele, you've seen that a skit where there's the way President Obama speaks, and then he's got his alter ego who wants to say it like he wants to say it. I thought Chair Warsh was very classy, like President Obama was, but man, I could read the tea leaves. He's like, "Hey man, I just got here. Why didn't you hammer that last guy for 5 years? Inflation's been up the whole time. Why didn't you hammer that guy like you're hammering me? Oh, I know why. Because the appointee for me is the president. I get it. No problem. Give me some time. I'll get back to you." He didn't say it like that. He was super chill. We're looking at the data. We've been here a little bit. I asked for a food fight. I spurred discussion. I got 3 dissenting votes, 9 and 3 dissenting. And of course, the 3 dissenters, they've gotten very hawkish lately, especially Hammock and Logan. And, he basically said we're going to let the market dictate this. Now, something I've said on here all along, which has been something for years, James Carville, famed political strategist that helped President Clinton get elected. He's out of New Orleans. I've seen him jogging. I talked to him a couple times when I was down in New Orleans. Actually, a pretty cool guy. In fact, one of my fraternity brothers is related to him. Shout out to Chris Carville, Cajun, if you're out there watching. He said, when I come back in another life, I want to be a bond trader. Because the bond traders have always led the Fed. They've always led the Fed. And Chair Warsh basically said yesterday, we're going to let the markets dictate what's going on. We don't want a reaction function. We don't want them to react to what the Fed says. We're going to sit back and let the market do its thing. The Fed likes to step in when there's a market dislocation or when there's credit issues or liquidity issues. That's where they like to go, which unfortunately he didn't say anything about the balance sheet. I wish he did. But if they start hiking rates, it is a big shift. And so they're going to take their time. So I give grace to both Powell and Warsh. By the way, the only reason we're above 440 and the 2-year Treasury has run up into the 4% range is because of oil. It's because of the Iranian conflict, which almost ended last month and then it didn't end. If that lasts a little while longer and there isn't like a readjustment with a resilient consumer and inflation continues to go up and that becomes the trend line, I think they're not giving forward guidance at the Fed, but I thought the 9-3 vote is the forward guidance. We're getting closer. And so that's it. That's all I think the market's going to get. Now, the next meeting isn't for another 6 weeks. It's in September. And, there's still a decent chance there could be a 25 basis point hike at that meeting, depending on what happens with data. We have jobs data come out too. He said the jobs market is steady. I would say that's probably, I think he said strong, but then he said steady. And I think it's steady, but I don't think it's as strong as we think. I think it's a no hire, no fire zone. And so if you are gainfully employed and you have a house, I think you're doing good. Wage inflation is keeping up with inflation. The weekly wages are keeping up with inflation. And so he also said he didn't want to surprise the market. Could you imagine if there was a 25 basis point hike yesterday? That would have been a shock to the market on his second meeting when there is no forward guidance and they aren't telegraphing what they're going to do like the old Fed used to do and have the market react to what they say. So I will say Jackson Hole is in between now and the next meeting, and that's traditionally been something where the table gets set for rate cuts like it did a couple years ago, and or in this case maybe a rate hike or hikes. Maybe there's an insurance hike of just 25 basis points, just because the market is dictating that they want to go there. But the market could also pull back. They're so, ingrained at looking at oil prices and inflation reads. And so the last 2 inflation reads have been good. We'll see if it's a trend. There should be at least 1 or 2 more major inflation data points coming out before the next Fed meeting. And I think the bond market will react to that and could lead the Fed. And so, if there are more votes and more dissenting, and maybe they'll hike 25 basis points. I don't know. There's a lot of time in the next 6 weeks for a lot of stuff to happen. We could ratchet up this war. We could end the war. We could have another memorandum of understanding. I mean, who knows? But again, most of the components inside these inflation reading reports we've seen are down. So other than energy, it's down, and down to a number below wages, and wages are keeping up if you have a job. I will say on the stock front, let's wrap this thing up here. I mean, I could go on and on about the Fed. It was so many good nuggets I put down. He did say clarity versus certainty. By the way, I thought he was stalling a little bit because remember the guy that appointed him wants him to keep rates low. So I don't think he's gonna hike on his second meeting, no matter what the data said. And so if it's dictated and the markets dictate it, they'll do what they have to do. But if the interest rates go up on the Fed overnight borrowing rate, then that would mean that our debt and deficit is more expensive, which is like the exact opposite of what the president wanted him in there to do. So, hey, best I can do is stall for 3 meetings. That might be the compromise. I don't know. Okay, Fannie and Freddie both made just under $4 billion in the second quarter. So housing is generally healthy from their perspective. GSE loans have pretty decent delinquency, but you have to look at 90-day plus delinquency rate, which they're both under 1%. And FHA is a little more tested there. There's delinquency, which means 30 days or more, and then there's more than 90, which is a little bit higher level of delinquency. So basically call it serious default. So we're trucking. Microsoft, they spent a little bit more in capital expenditure, but then they booked it as an expense and extended their AI data centers from 15 years to 25 years out. So they booked it on a different line item. So CapEx didn't go up. Thus, their profit didn't get eroded. And they made more money in Azure. We're a Microsoft office on Azure. Microsoft made some money and they ripped yesterday and today after that. Apple had a little bit different thing. It's not a CapEx thing. They just, they had a lot of iPhones bought. For those of you that are iPhone users, thank you. Proud shareholder since 2004. I was telling some buddies of mine to sell that stock before the earnings report, and sure as hell, it sold off. They kind of pulled forward some of their revenue, and with the iPhone sales, and their services went down a little bit. The stock will come back long term, great long term hold, might be a buying opportunity. Meta spent a lot more money, went from $8.5 billion in free cash flow to like 737. Got punished. Google, same thing, got punished. Amazon crushed it. Their capital expenditures turned into AWS, windfall for them. So, companies like that or like ours who are spending money on AI, if there's ROI, you will be rewarded. And by the way, the IPO market's kind of drained right now. SpaceX took a lot of the wind out of the IPO market. A lot of money came out of that. And so, people who want to go like Anthropic or OpenAI or whoever, although Jersey Mike's just went today and they sold off, of course, there's a lot of money that went out there and maybe doesn't want to pay off the original investors for the public offering. There is a timing to IPO. Like there's IPO cycles, and SpaceX may have just brought the cycle down a little bit. Have you noticed that most mortgage companies have not gone public since 20 and 2021? That was the window when we were all doing great. We had all these awesome numbers. So they go tap the public markets. And by the way, if a company's public, it doesn't mean the whole thing's public. Part of it is public. And so that is a lever to pull to get cash, right? And so it doesn't mean every company that's public is 100% public. And if you look at their share price, like that's indicative of how they're doing. So there's just something to think about when you analyze businesses and you want to talk about financials. It's a very important distinction. Is a company 9% public, 19% public, or 100% public? Anyway, I could go on and on and on. Have a wonderful weekend. July is coming to an end. Not a bad month. And locks are up over June. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.